Have you ever wondered if a robot could make you rich? Imagine a future where artificial intelligence, or AI, is no longer confined to science fiction, but is an integral part of our everyday life, including the stock market. Could it be possible that these machines, with their superior computational abilities, might outperform us in making profitable trading decisions? Could the rise of AI mean the fall of human error in stock trading? Today, we're going to dive into the fascinating world of AI in stock trading. AI has been making waves in the stock market for quite some time now. AI, or artificial intelligence, refers to machines or software that mimic human intelligence, making decisions based on analyzed data. In the context of the stock market, AI is a game changer. Through a process known as machine learning, AI can sift through colossal amounts of data at lightning speed, identifying patterns and trends that may slip past even the most eagle-eyed of traders. This data can include past stock performance, news articles, social media sentiment, economic indicators, and more. The ultimate goal of AI in stock trading is to predict market trends, helping traders make more informed decisions. It's like having a crystal ball that's powered by algorithms and computational power. But how does AI really work in the stock market? Let's break it down. The first step in the process involves data gathering. Now, what does this mean? Well, in the world of artificial intelligence, data is king. It's the fuel that powers our AI engines. Without data, our AI is like a sports car without gas. It might look impressive, but it's not going to get us anywhere. So how do we collect this data? We use algorithms. These are sets of rules or instructions that the AI follows to perform a task. In our case, the task is to gather data. But where does this data come from? It comes from a variety of sources. One of the most important sources is historical stock data. This includes information like the opening and closing prices of stocks, the highest and lowest prices during a trading day, and the volume of shares traded. But that's not all. We also gather data from social media. This might seem surprising, but social media sentiment can actually have a big impact on the stock market. If people are buzzing about a certain company on Twitter or Facebook, it could drive the price of that company's stock up. On the other hand, if people are spreading negative news about a company, it could cause the stock price to fall. In addition to social media, we also collect data from news sources. News articles can provide valuable insights into a company's performance and future prospects. For example, a news article about a company landing a big contract could signal that the company's stock price is set to rise. Lastly, we gather data from other financial indicators. These could be things like the overall health of the economy, interest rates, inflation rates, and so on. These indicators can help us understand the broader context in which the stock market is operating. Collecting all this data is no small feat. It requires powerful computers and sophisticated algorithms. But it's a necessary step if we want to use AI to navigate the stock market. Now that we have our data, it's time to move on to the next step. The second step involves processing and analyzing the collected data. Now, this might sound like a daunting task, especially considering the sheer volume of data we're dealing with. But this is where artificial intelligence truly shines. In the realm of stock market data, AI employs advanced techniques like machine learning to analyze and process the data. Machine learning is a subset of AI that allows computers to learn and improve from experience. So, instead of programming a computer specifically on what to do, machine learning allows it to learn and adapt through exposure to data. Now, let's break down how this works. The machine learning algorithms are fed with the collected data. This data could include stock prices, financial news, social media sentiment, global events, and even weather patterns. The algorithms then chew through this data, learning and adapting as they go. One of the benefits of using AI in this context is its ability to identify patterns and trends in the data that might be missed by human analysts. These could be subtle shifts in market sentiment, emerging trends in certain industries, or even signals of a looming market downturn. For example, AI can analyze social media sentiment to gauge public opinion about a company or a particular stock. If the sentiment is largely positive, it might indicate that the stock price could rise. Conversely, if the sentiment is negative, the stock price might fall. Also, AI can analyze financial news and global events to predict their potential impact on the stock market. If a major tech company announces a breakthrough innovation, AI can predict how this might affect the company's stock price and the tech industry as a whole. And it's not just about spotting trends. AI can also analyze the relationships between different variables. It can understand how a change in one variable, say interest rates, might impact another like stock prices. Once all this analysis is done, the AI has gained a comprehensive understanding of the market dynamics. It has identified trends, spotted patterns, and understood relationships. It's like a seasoned market analyst, but on steroids. Once the data is processed, it's time for the AI to make some predictions. The third step is where the magic happens. Once we've gathered and processed our data, it's time to let the artificial intelligence do its thing and make predictions. But how exactly does it do that? Well, let's paint a picture. Imagine a seasoned chess player. They've played thousands of games. They've seen all sorts of moves and counter moves. They've studied the patterns, learned the strategies. Now, when they sit down for a game, they can anticipate their opponent's moves, not because they're psychic, but because they've seen it all before. That's essentially what our AI is doing, but instead of chess moves, it's analyzing stock market trends. The AI uses the processed data to look for patterns and trends, to understand the rhythms of the market. It takes into consideration factors like historical data, current market conditions, and even news events that might impact the market. What's fascinating is that the AI doesn't just make predictions based on past data. It also learns from its past predictions. If a prediction turned out to be accurate, the AI takes note. If a prediction was off, the AI adjusts its algorithms, learns from the mistake, and improves. It's a continuous process of learning and tweaking, making the AI more accurate over time. Now, these predictions are not foolproof. The stock market is notoriously unpredictable, and no AI, no matter how advanced, can guarantee 100% accuracy. But what the AI does provide is a calculated forecast, a glimpse into potential future trends. And this is where it gets exciting for traders. Armed with these predictions, traders can make more informed decisions. They can identify potential investment opportunities, manage risks, and even devise new trading strategies. They can anticipate market shifts, get a head start on their competition, and position themselves for success. In essence, AI predictions are not just about predicting the future. They're about empowering traders with the tools they need to navigate the stock market effectively and efficiently. Now that we have our predictions, what's the next step? The final step is making trades based on the AI's predictions. As we've established, AI can predict market trends with a level of accuracy that's simply unparalleled by human traders. But the truly fascinating part is how it takes these predictions and turns them into real-world trades. Imagine a world where every trade is executed at the perfect moment, a world where trades are placed faster than the blink of an eye, with such precision that it leaves no room for human error. Sounds exciting, doesn't it? Well, welcome to the world of AI trading. AI doesn't just make trades, it makes them efficiently. It can scan enormous amounts of data in real time, allowing it to react to market changes instantaneously. This is a critical advantage in a world where markets can fluctuate wildly within seconds. Now you might be wondering, does this mean AI never loses? Well, not quite. Like any system, AI isn't infallible. However, the beauty of AI is that it learns from its mistakes. It constantly tweaks its algorithms based on previous outcomes, steadily improving its performance over time. Moreover, AI doesn't have to deal with the emotional baggage that often clouds human judgment. It doesn't panic when the market takes a dip or get overly excited when stocks soar. It simply follows the data, making calculated decisions without the influence of fear or greed. But perhaps the most impressive feature of AI trading is its ability to monitor the market in real time. It can adjust its trades as necessary, ensuring that it's always in line with the latest market trends. This adaptability is crucial in an environment as dynamic and unpredictable as the stock market. And there you have it. The marriage of artificial intelligence and trading is a match made in heaven, offering a level of speed, precision, and efficiency that's simply unmatched. From collecting and processing data to making predictions and executing trades, AI is revolutionizing the way we interact with the stock market. And that, in a nutshell, is how AI works in the stock market. So to wrap things up, we've journeyed through the world of artificial intelligence in stock trading. We've seen how gathering a wealth of data is the crucial first step, followed by the pivotal process of data processing. Then, we delved into the exciting realm of making predictions, harnessing the power of AI to foresee market trends. Lastly, we examined the final step of making trades based on those informed predictions. With the power of AI, the future of stock trading looks brighter than ever.